Hi, I am Dimitri from Silver & Young Private Wealth, and I'd like to welcome you to a new episode of Behind the Wealth podcast. We explore, investigate, and analyze topics of wealth creation. Hello, and welcome back to our new episode, Behind the Wealth. Please consider everything we say today is as a part of a general advice, as I don't know your specific details to give you advice. So you need to talk to your accountant or your financial planner to take really tailored advice for your needs. Today's subject, I thought we talked about saving 10%, how to invest, different ways of investments, and also the bias we have when we choose an investor, and also misconceptions that we have about different investments in the previous podcast. In today's podcast, I would really like to talk about the vehicle behind the investment. You see, every successful investment, it needs to accommodate a couple of things. Number one is it needs to accommodate the issue, okay, if we make profit, how are we going to be taxed for this profit, and how we can get the best use of this profit. And if we make loss, how are we going to accommodate this loss and offset these losses against previous profits, current profits of the year, or future profits. And of course, in every transaction has a couple of elements of profits. One, it is, we call it on the revenue side, say profit and loss. We buy something for $100, we sell it for $200, and we make a profit this year of $100. The other thing is we buy a parcel of share, $100, we sell it for $200, and we make a capital gain, $100. And the two these components of profit sometimes taxed, many times taxed a bit different than straightforward, I made $100, how much tax I will pay. So we need to consider different strategies, how to do the initial investment and how to put it under the right structure, not to consider after we have the profits or after we have the losses. And I ask a question. For example, a lot of times, do you ever consider if you buy a property, do you buy the property in your name only because you are the main earner? Or you buy in your wife's income or your husband's income who has lesser income than you? And this is, of course, the answer to this question. You probably ask me, okay, when I'm going to make the profit? Because this is a different answer. If I buy a property and I know in 15, 20 years it's going to be double in price, I bought it for $500,000, and in 20 years it's going to be more likely worth $200,000, $1 million. So I'm sitting on a $500,000 capital gains, then it's a different answer to if we say, okay, I buy a positive yield property that today I bought for $500,000 and I make $20,000 income, I pay $10,000 expenses, and I get extra $10,000 every year. So this revenue income from the rental is being taxed every year, and it has to be then taxed to the person who owns the property. So the question is, where is going to be the profit? What sort of profit? And the timing of the profit. And this is all these questions helping us to answer in what entity we should have the property. You should buy 50% you and your wife when you earn equal amounts of dollars. Or you should buy 99% on your name when you earn the majority of the income and 1% to your wife or to your husband who or she earns the lesser income. If now we sell this property 10, 15 years time, of course, we want to have the property aligned to the person who earns less money, so we have to pay less capital gain for the obvious reasons, because his income is little or no income. So any profit we will have will be taxed on a lower rate compared to the high income earner. So I don't try to give you the solution now because the solution is quite complex and involved. But what I try to say, before you buy, for example, an investment property as a negative yield or positive yield, you have to consider what the percentages, who is going to be the owner of the property, you and your wife, or you and your husband, a company, trust, a family trust, and all these, a lot of questions to be answered. And it cannot be answered in just 5 or 2 minutes, because we need to see what is the end result we want to achieve. If I want a negative yield property now to save some tax and then participate in a potential capital growth, I maybe need to get the property all in my name, or the majority of the property, the equity of the property in my name, so I have the better deductions and I have the more benefits from the tax point of view. But if I'm looking in a long-term position that usually properties are, and then we're looking at 15 to 20 years later, then I need to consider, at the best of my ability, where I'm going to be in 15 to 20 years from now. And if there is a really long and strong property growth scenario, and I'm sitting on a lot of capital growth, who do you want to have that profit in what name for me to pay less tax? Other scenarios, for example, if I buy a parcel of shares. If I buy a parcel of shares, $20,000, $30,000, and I'm hoping to make a 10%, 15% return a year on dividends and other capital gains, which is all taxed on a yearly basis if you don't hold the shares more than a year. So who do I want to have that profit? I can buy this share portfolio in my wife's name, who she works and she makes $100,000, or in my name that I work only part-time and I make only $20,000. So if I make more profits, I'll pay less tax because my margin rate is less. But there is the other way, the other side of the coin. If I make losses and I haven't really realized that my expectations that I'm going to make profits and I make losses, then the loss is going to be deducted out of my $20,000 income. So I'm going to be below my tax threshold and I don't gain any benefit compared if my wife, who earns $100,000, had the losses of $20,000 and we diminish her income from 100 to 20 and saves 40% or so from the tax payable at that year. So it's always a catch-22 because we don't know really what's going to happen. So what is the key point here? Of course, we hope for the best, but we need to plan for the worst. And how are we going to plan for the worst? We need to have in a position that if we make profit, we're happy or well enough to accommodate the issue of the tax at the best possible way, to pay lesser tax and to take more advantages of the worst case scenario if we have losses. And I'll give you an example. A lot of people, they go and rush to do family trust. And they do a family trust because they want to put a share portfolio of $200,000, $300,000, or they want to put a property that makes money, and they suddenly doesn't go as well as they thought. And there is a losses in a trust. The trust cannot distribute losses to the beneficiaries, can only distribute profits. So what's going to happen? Suddenly we have $20,000, $30,000 losses on a $100,000 investment or more, and then we cannot distribute the losses because the owner of this investment is a trust, is a family trust. So you cannot distribute from a family trust a loss. So it sits year after year till we have in the next year or the following year some profits, and these profits then absorbs the losses of the previous year. Now, other stuff. Say, for example, some of the family trust doesn't have a threshold exemption for land tax. So if you buy property in a family trust and your land is worth $800,000, suddenly in New South Wales, for example, you hit you with a property with a land tax and from no threshold. But if you bought the property in your name, your home is of course exempt from land tax, and there is a certain amount of 600,000 and so and more that it is land tax exempt. So suddenly you are better off from day one if you bought a property in your name or your names you and your wife or you and your husband compared to a family trust from day one. So what is important about also the negative gear of property? So I mean, we all like negative gear properties because of the tax benefit. This is partially wrong because at the end of the day, we need to make money all the way around till we achieve the maximum capacity of capital gains in the future and when we sell the property. And we need to manage the loan between now and selling the property. But for high income earners that they have a really big tax liability, and there is a good argument to buy a negative yield property because negative yield property will save them tax. And then it is important to have the property in the name of the high income earner because that's the aim. The aim and the formula of the investment is I buy a property because I have a good borrowing capacity. I use my borrowing capacity to buy a good capital gain property, but in the first few years, I may be running on a loss after depreciations and after interest paid and expenses, but I will take the benefit of these losses because it diminishes my high income earnings. So I get some of this back from the tax, but I hold a good value property for the long run. A better proposition for this is to have a positive yield property. Although I know we pay more tax, but it contributes to the value of net assets for us from day one instead of 5 or 10, 15 years. Even better proposition of that is to have one negative yield property and one positive yield property. The two of them offset each other, so I don't have any really extra tax. It doesn't cost me any really money. Roughly, it is a positive, a neutral cash flow, but I hold two great assets that hopefully in 10, 15 years will give me a lot better result than if I didn't hold any property or one property. The other question usually we have is, I want to buy a small parcel of shares, 20, 30, 40, $50,000. Where should I buy? Should I buy in a partnership, as a sole trader, as in my name, or I buy in a company? There's no right and wrong answer because all depends on your personal circumstances. But usually a small parcel of shares that it is for investment or trading account, usually we buy for the person or the family member, husband, wife, that he or she has a lesser income, which we hopefully we make more money and then she won't be taxed or he not going to be taxed on a high income. But we need also to accommodate the issue. What about if we have a severe capital loss? What about if we have a downtrend in the market and we picked it wrong the market and we lost some money? What I'm going to do the loss? We need to contemplate this and we consider, okay, if I have a capital loss, what I'm going to do with that? It's possibility for me to regain or recoup this loss in the future, or there is no chance. If there is no chance, it's better then to forego the short-term benefit of saving some tax because of the low income and go to the other side, although we don't save too much tax by having on the husband's name or the wife's name, then maybe we have it in a different scenario that we don't save tax, but also we avoid that we're never able to absorb the capital loss. What I'm trying to say today is the following. Before we do an investment, it is very, very important to consider in which vehicle we put this investment. It's exactly the same scenario. You want to move a fridge from A point to B. So you put a parcel of money in here and you're going to move it over the time, over there, and hopefully this produces some results. Which vehicle is the best way to move that, considering all factors, considering tax, considering future capital gains, consider future capital losses, consider control, consider accessibility to the funds and easy to manage this entity, consider cost of entity to set up. I mean, to set up a company and a trustee company and a family trust and a super fund, an SMSF trust, self-managed super fund trust, all this is cost money. Is worth all this money and effort compared to a simple scenario to have the investment directly in our names or on a different percentage for tax benefits. The other thing I would like to say is a lot of couples sometimes they buy one property in one name because it is the higher income. I really don't like this scenario. I prefer the 99.1%. And the reason I prefer the 99.1% is to save the ladies from the men from midlife crisis. And I'll explain what I mean. So for example, me and my wife, I am the high income earner. She is the low income earner, for example. So we buy the property 100% in my name to have the best deduction because it's a negative gift. Or because the property is really positive gift, we buy all the property in the name of my wife because we want all the income to go to her and not to me, so I won't be taxed. So one of us has a midlife crisis. I go with a young lady 20, 30 years younger than me, and I have a property 100%. I'll lose a bit my balance in here, and then what's going to do? I'll sell the property. She could never know that I sold the property because she's not part of the equity and probably not part of the loan acquisition. The same also happens to her. She could sell that property, the positive gift property that earns good money and we want to save tax without asking. Having a 99.1% is not going to save the marriage. And it's not going to avoid the unavoidable if I lost my balance and I lost my mind through a midlife crisis. So this is not going to save your marriage, but it saves financial transactions and griefs that no one can sell any family asset without the other person's permission. And this is very important for people where they're really blinded by saving tax from day one. And another point I want to say is it's a good tactic, it's a good proposition to go and pay someone a little bit of fee to get an advice, even a generic advice. And a lot of times when people come to us, we say, okay, I want to do this, I want to do this. And we say, okay, you want to buy a beautiful restaurant and you're going to be a millionaire, you're going to be the best restaurant in the mountains, I don't know where you buy the property, the restaurant. Okay, good. Till we prove that everything's working, then do it as a sole trader, which is cheap and has very little, it's very flexible and no cost, almost no cost. Then if we do well, then we go to a partnership with your wife or your husband or your best friend, and then we go to a company structure, and then we go to a more complicated structure with company, trust, and other stuff to accommodate the growing demands of profits and capital gains and potential capital losses. So it is worth to have the conversation, even if you do nothing, because what it does, it paves the path for you to have the idea where you're supposed to go the next day that you have a tax problem, the next day that you will have a tax loss, the next day that you do well or not do that well. So then you already educated yourself, and then you can go back and ask the accountant or the financial planner, all right, you told me 6 months, a year ago that I start, now I'm making money, what I need to do now. I think now I'm confident and I prove to myself that my little coffee shop or my little restaurant or my little business is working well. What I need to do next to put the business in the right structure for the next stage. And you do again for the third stage and the fourth stage. And this is how really you build up wealth in the right way, because you accommodate this, the possibility of a higher profit, the possibility of a capital losses, the possibility of the capital gains, the possibility of control, the possibility of estate planning. What's happening now if I pass away? Who's going to control this, and how it is, under which entity will be easier to be controlled for my family to move on? I know the issue is a bit complicated, and I hope I didn't confuse you too much. But if out of this conversation, the moral of the story is the following. Before you do an investment, talk to your accountant, talk to your financial planner, and ask them, I'm planning to do A, B, C, and I hope that I will have that profit. The risk is this. Under what structure should I put it in? It's worth spend money. It's worth spend 1 hour, 2 hours, sit with someone who does this day in, day out, and will address and will tell you, you should do this today, this tomorrow, this after tomorrow. Then you know you are in the right path for the future. Till the next time, I hope you enjoyed the webcast, the podcast, and till the next time, have a good time. If you have any questions, please give us a call on 96007760 or email us on pw@silverandyoung.com.au, P as private, W as well, silver as the metal, young as the youth.com.au. Till next time, have a good day.
I hope you have enjoyed our recent episode Behind the Wealth, provided to you by Dimitri from Silver and Young Private Wealth. If you have any questions regarding our recent episode, please email us on pw, P for Peter, W for Word, @silveryoung.com.au. Until next time, have a good day and enjoy life.